Hello and welcome to today's daily report market analysis videos with me, Richard Perry, market analyst at Hantech on Thursday the 27th of February. We have a continued selling pressure through markets. The fears of the coronavirus continue to escalate. You're seeing that cases are now popping up in the United States, and not only that, there's a real fear that the Centers for Disease Control and Prevention in the US have suggested that the one in California has an exposure of unknown origin. So it doesn't have any connection really to China or any of the exposed regions. So it is a really difficult one to know how to sort out, where they're sort of finding that if the virus continues to escalate and they don't really know where it's coming from, it's difficult to isolate it, and subsequently it becomes a really difficult way to control the spread of the virus. So subsequently what we're seeing is equity markets selling off sharply. We've seen volatility continuing to remain sharply elevated. We've seen equity markets selling sharply down. You saw the S&P 500 rallying yesterday, but then as this announcement from the CDC in the US came out, you saw the S&P 500 falling sharply into the close, and futures are down again today, and you've seen that European markets are down 1.5% at least at the moment, so really is significantly hitting equities. Safe haven plays are benefiting from that as gold is finding support. The 10-year Treasury yield is at all-time lows, below 130 big figure support on the yield, or 130 big figure on the yield, as bond investors continue to pile into treasuries, dragging the yield lower. And at the moment there's a kickback against the US dollar, but ultimately I don't think that's going to last, because I think that the volatility levels throughout throughout treasuries, forex and equities tends to be dollar supportive. So subsequently we're seeing a minor move against the dollar at the moment, but I just don't see that lasting for too long at the moment before the dollar is likely to turn around. You still got this positive correlation between the US Treasury yield, I should say negative correlation, because this is an inverted chart, so negative correlation between falling Treasury yields and rising gold price. So again, that should continue to support gold. So some really significant moves we are seeing across markets today. The oil price, again, plunging to multi-month lows. January 2018 is the lowest it's been since, and subsequently we're seeing a downside that ultimately will open, if I show you across 2 years, levels not seen since the December 2018 levels, and ultimately that a retest of that 42.35 low could well be seen. So, lots going on in markets today. Now, we've got some data points, mainly US focused today. You've got the next reading or the second reading, I should say, of GDP at 1:30 for the US. That's down here. Expected to be confirmed at 2.1%, but we're also looking out for the durable goods orders. That's expected to drop by 1.5% on the month, and pending home sales at 3 o'clock expected to improve by 2.2% in January. But the focus is clearly on the coronavirus and how that is playing out at the moment. So that takes me on to my chart of the day, which is Euro Sterling. Now, I said in the morning report that I saw Euro Sterling rallying. Euro has engaged in a recovery against the dollar, and Sterling is sort of holding ground, so subsequently that equals Euro Sterling higher. But how long for would be the question, because you've got a recovery on Euro Sterling that is now into some overhead supply areas, and ultimately it looks as though that, the Euro rally is still likely to be a near-term move. You've had this unwinding of the sharp move lower since August, which has effectively broken this downtrend now, but you're now into a clutch of resistance area here, and it seems as though that ultimately is likely to be seen as a chance to sell again. It's just unwound the daily RSI back towards those mid-50s levels where the December and January and early Feb rallies petered out. You've got the MACD lines, which are rising, following on from a bull cross, but ultimately that's just reflective of the recovery that we've seen in the last week and a half, along with the stochastics, but they're all sort of rising up towards levels where the selling pressure has tended to come back in again. So it's likely to be that this is going to be a rally that will be sold into. Obviously for now the near-term reaction is higher, so we need to watch out for that, but you're looking for exhaustion signals. You're not getting the exhaustion signals quite yet. Sorry, that's gold. Not seeing the exhaustion signals quite yet, and the near-term rally is still in process, and you can see that through how the RSI on the hourly is up in the 80s, and the MACD line is well above neutral. But ultimately, we're looking, as I said, for exhaustion signals starting to come through, but we're not seeing them quite yet. So once that resistance does start to set in, I think it would be a selling opportunity on the euro sterling for the medium-term outlook, which remains bearish and negative. I sort of mentioned in the daily report that the 55-day moving average has been a basis of resistance. It's pretty much since October, basis of resistance, not to the pip, but it's around that sort of level now. So again, once more, it's another indicator which would suggest that this is sort of coming into the realms of turning points again. So watch out for exhaustion signals. So with that in mind, I wish you good luck in your trading today. Click here to sign up for our analysis videos, and also go to our website to join up for our trading webinars.